The currency is a credit. If you look at a central bank's balance sheet, you can see quite plainly that currency in issue, both in terms of notes and also what are called bank reserves, commercial bank reserves. In other words, electronic records of money owed by the central bank to commercial banks. That's all on the balance sheet. There's a counterparty risk.
This analysis looks at the potential financial crisis Alasdair Macleod talks about. He warns about the shaky state of banks, the growing number of failing businesses, zombie companies, and how it's getting harder to borrow money because interest rates are so high in our struggling economy. Want to understand what this means for your money? Watch this video and don't forget to like and subscribe. Before we dive in, if you've ever thought about investing, the first link in the description takes you to Interactive Brokers, the platform I use. The psychology of bankers. Bankers live in a risky world. They know many businesses they lend to might not survive high interest rates. These are often called zombie companies, basically kept alive artificially. So, what would you do if you were a banker and saw a bunch of your loans going bad? Naturally, they get nervous and want to protect their bank. They see businesses struggling and fear a downturn. Wouldn't you be worried about handing out more money that might never get paid back? So they tighten lending and become more cautious. It's a natural reaction, but what are the wider consequences for the economy? Zombie companies are a big problem for the economy. They don't earn enough to pay their debts, but they're still around, which messes things up. They use up resources and pretend everything's okay. Bankers face a tough choice with these companies. Writing off loans looks bad, so they often try to keep them going. This can create a dangerous cycle. When the economy gets worse, these companies struggle even more, and bankers have to decide whether to keep supporting them or cut their losses. Either way, it's a difficult decision with big consequences. The global banking system is interconnected. High leverage in foreign banks adds another layer of complexity. Many banks operate with significant debt relative to their equity. This poses risks not only to their stability, but also to the broader financial system. In regions like the Eurozone and Japan, leverage ratios are alarming. Banks often operate at levels much higher than their US counterparts. This increased risk can lead to a domino effect. If one institution falters, it can trigger a chain reaction across the financial landscape. Bank directors watch these dynamics closely. They know that their exposure to foreign banks can amplify their vulnerabilities. As concerns about leverage grow, the instinct to tighten up becomes stronger. Protecting shareholder value becomes a primary focus. Understanding margin loans. Margin loans are a crucial aspect of the financial ecosystem. They allow investors to borrow money to purchase securities. This practice can amplify gains, but it also increases risk. When the market is bullish, demand for margin loans typically rises. However, in a declining market, the opposite occurs. Investors begin to pull back. Margin debt contracts sharply as banks tighten their lending criteria. This shift reflects the cautious mindset of bankers, who prefer to limit exposure in uncertain times. As the market fluctuates, the psychology of borrowers changes. When optimism reigns, investors are eager to leverage their positions. Conversely, during downturns, the fear of losses drives them to reduce their borrowing. This response can significantly impact market dynamics. The impact of bank credit. Bank credit plays a critical role in shaping economic activity. It fuels spending and investment. When banks tighten their lending, the effects ripple through the economy. A contraction in bank credit can lead to a decline in GDP. As banks pull back, the flow of money slows. This can create a feedback loop. Less credit leads to reduced spending, which can further depress economic growth. Bankers understand this cycle well. They know that their decisions have far-reaching consequences. The current environment raises alarms. As banks begin to contract their balance sheets, the implications for the economy become dire. The potential for a significant downturn looms. The interconnectedness of bank credit and economic performance cannot be understated. The importance of bank liquidity. Bank liquidity is essential for financial stability. It refers to the ability of banks to meet their short-term obligations. Without adequate liquidity, banks cannot lend or support the economy. This situation can lead to a credit crunch, where businesses struggle to access funds. In times of economic stress, liquidity becomes even more critical. banks must ensure they have enough cash on hand. This allows them to respond to withdrawal demands and support client needs. A lack of liquidity can create panic among depositors. When people fear for their savings, they rush to withdraw funds. This can lead to a bank run, further destabilizing the institution. Effective liquidity management is a balancing act. Banks must weigh the risks of holding too much cash against the potential returns from lending. However, in a tightening economy, the focus shifts. Protecting liquidity becomes paramount. The instinct is to hoard cash rather than lend it out. This shift can exacerbate economic downturns. Economic indicators and bank strategies. Understanding economic indicators is vital for banks. These indicators guide their lending strategies. Banks closely monitor interest rates, inflation, and unemployment rates. Changes in these factors can signal shifts in the economic landscape. When interest rates rise, borrowing costs increase. This can lead to reduced demand for loans. Banks must adapt quickly to these changes. They may tighten lending standards to mitigate risks. This cautious approach aims to protect their balance sheets. Additionally, banks assess the overall economic environment. A declining economy often leads to increased defaults. Banks need to anticipate these risks. They adjust their strategies accordingly. This may involve focusing on more stable borrowers or sectors less affected by downturns. The historical context of banking crises. Banking crises are not new. They have occurred throughout history, often triggered by economic imbalances. The lessons learned from past crises are invaluable. They highlight the importance of sound banking practices and regulatory oversight. Historically, banking failures often stemmed from excessive risk-taking. Banks over-leveraged themselves, ignoring warning signs. When economic conditions deteriorated, these institutions faced dire consequences. The Great Depression serves as a stark reminder of the risks involved. As we reflect on history, it becomes clear that vigilance is crucial. Banks must maintain adequate capital reserves. This helps them weather economic storms. Understanding past failures can inform current practices. It reminds bankers of the importance of prudence and caution. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. The current financial environment. The current financial environment is challenging. High inflation and rising interest rates create uncertainty. Many businesses struggle to adapt to these conditions. This can lead to increased defaults and higher credit risks for banks. In this climate, banks are becoming more selective. They scrutinize loan applications more closely. This cautious approach aims to minimize exposure to potential losses. As credit tightens, businesses may find it harder to secure funding. The interconnectedness of global markets adds another layer of complexity. Economic troubles in one region can quickly spread to others. Banks with significant exposure to foreign markets must tread carefully. They need to assess the risks associated with their international dealings. Future predictions and risks. Banks face big risks, like a worsening economy and potential cash shortages. This could mean less lending and even bank failures. New regulations add to the uncertainty. For us, this could mean harder times getting loans and a less stable economy. Banks need to be prepared to avoid a bigger crisis. For those interested in learning more about investing, I've had a positive experience with Interactive Brokers. The link to their platform is in the first link of the video description. If you enjoyed this video, please give it a thumbs up and subscribe to our YouTube channel for more great content.